Coming up today, stocks slide low into Thanksgiving, JP Morgan's forecast for next year, the FTC goes after Microsoft, should investors give up on international stocks, the latest economic data, Kramer gets more bullish on crypto, and the asset that just broke out to a 50-year high that affects you every day. You don't want to miss this one, guys. Let's go. And welcome back to the Daily Market Review, everybody. And before I show you the asset that just broke out to a 50-year high, you might want to buy the dip on as soon as you can. First, I just want to say a huge thanks to everybody who's joining me on my new swing trading journey. I've been absolutely blown away by the response and feedback from you guys. It's been amazing, so thank you. And I guess that's because unlike the hundreds of other similar trading services out there, I'm actually trading my own real money in front of you guys, as I send out all the swing alerts the night before I trade them, just as I've done with my stock pick service, which has been absolutely crushing it this year. My stock picks account up 30% since June, tripling the market's return, and this is with no leverage and a highly diversified portfolio. So all my members are super happy heading into the holiday period, and most of them have actually jumped on board my new swing trading alert service due to overwhelming demand. And so as you guys know, I can only allow 300 members onto this service, and spots are filling up quickly. In fact, at time of making this video, there are only 47 spots left, and once they're gone, I will be closing this service to new subscribers. So you will see this closed any day now. And trading has already begun in my new swing trading account. This is a real money trading account. I deposited $30,000 in. I'm not paper trading here. All alerts are sent to members the night before I trade them, and I've already got 3 trades open, all of them already in the green. But of course, it's still early days. My goal is to turn this new swing trading account into $1 million, and then meet up with all the members in Vegas to celebrate. And so I'm 100% serious and committed to achieving that goal, and I'm not going to stop until I do. So if you've been thinking about joining us for the journey, then click the link below this video and head on over to my website, clickcapital.io, and secure your spot while you can. Because like I said, any day now, this will be closed to new members. And that is not a marketing tactic. I'm 100% serious about that, as I want to ensure all members get a quality service. So like I said, if you've been thinking about jumping on board, now could be your last chance to do so. Okay, just diving back in the daily market review, it's actually coffee futures breaking out to a new 50-year high. Just looking at the daily chart here, it's been on a really strong parabolic rip, but it's going out to a 6-month chart. That's the highest close we've ever had. Did trade a little higher intraday back in January 1977. And you'll see this with a lot of commodities, trading these big, long, multi-decade ranges. And a lot of commodities like this have more upside volatility, as opposed to stocks that can sharply fall. Commodities can spike on the upside, and that's what we're getting right here in coffee. And like most big moves in markets, that's due to underlying fundamentals. We've got dry weather hitting supplies, shortages due to record-breaking drought in Brazil, they're the world's largest coffee producer, and Vietnam, another major producer, also faced extraordinary dry weather this year, giving us a bit of a supply crunch. And so just like I've been saying about electronics lately, due to the potential of tariffs coming in next year, if you're like 72% of all adults and enjoy a morning cup of joe, you might want to buy the dip on any coffee beans and go online, look for any suppliers or any retailer who just happens to be having a sale on coffee. I would say now is a good chance to stock up, as just like the name of the market suggests, futures, pricing in the goods, looking out in the future, with typically a several week to several month lag at what we pay in the stores retail. But it's not just coffee either. We've got agricultural commodities as a whole pushing up to yearly highs here. So food in general could be about to get more expensive, and that indeed adds upside pressure to inflation as well. However, we'll touch on that later, along with the latest numbers. So stick with me today. I've got an interesting one for you, including all the latest shenanigans coming out of the crypto space, amongst a bunch of other things I'm excited to share with you guys today. And there's a look at the sector performance for today. Once again, a lot of dispersion, especially going into lunchtime. Look at that. The leading sector at lunchtime, healthcare, up 0.7%. At the same time, tech was down 1.2%. That big divergence closed a bit as we went into the close there, and most sectors finished off for the day. And there's a look at the S&P 500, just a touch under 6,000. My S&P 500 oscillator just pulling back a bit from those overbought levels. Still a little bit too early to determine whether we're looking at a short-term top here or we're about to go into a grinding melt-up mode going into Christmas. Still quite bullish and green across the board. Red everywhere the bulls want to see it. Volatility, yields, oil, energy, and inflation expectation. We're just looking at sector breadth as well. Still overwhelmingly green. Most stocks above the 20, 50, 200-day moving averages. And so the market shut tomorrow for Thanksgiving, public holiday in the States. Typically this week in the market is normally bullish, low volatility into the weekend as well. Remember, Friday's a half-day trading. New York Stock Exchange closes 1 p.m. on Friday. And Friday will also be the last day of trading for the month of November as we head into December on what's been a pretty good year in the market so far. And because we're getting close to the end of the year, forecasts for 2025 are starting to roll in. Biggest bank on Wall Street, JP Morgan, sees the S&P 500 rising 8% next year to 6,500. And we can typically see that in the third year of a bull market, first year in the election cycle can be a little softer than the second year of a bull market, which was this one, along with the election year. So I'd tend to agree with JP Morgan Morgan. 8% seems like a good target, 6,500. Keep in mind the S&P finishes up for the year 74% of the time. 3/4 of the time, stocks finish each year higher. So it's a safer bet to say they're going to go up. And since we've just come off 2 great back-to-back years, wouldn't be surprising if the market did take a little bit of a breather. We got some consolidation, no doubt, a 10-15% correction in there, a few surprises, volatility episodes. However, I think 6,500 is a good target, but the market is hot. We've got the Momentum Factor ETF up almost 40% this year. So that's an ETF that systematically invests in stocks based on their 12-month returns. Momentum's actually the premier anomaly when it comes to factors. It's actually got a better track record than value and quality. Like Isaac Newton once said, an object in motion tends to stay in motion. And we witness that phenomenon in financial markets as well. There's a look at the iShares Momentum Factor ETF. Pretty solid uptrend there. We've also got a catalyst for NVIDIA, with its stock currently pulling back. However, we have a little bit of a catalyst in a little over a month from now, the Consumer Electronics Show, with CEO Jensen Huang delivering the opening keynote at CES 2025. The show will be held from January 7 to January 10, and quite often going into these events, and you see that with hot stocks like NVIDIA, Tesla, and other really well publicly known stocks, they can often trade up going into these hot events as the market gets excited that we may get a new announcement, or just the fact there's going to be media headlines and attention on the godfather of AI, Jensen Huang. However, on the other hand, the United States Federal Trade Commission just decided to open an antitrust probe into Microsoft on the eve of Thanksgiving. Kind of interesting timing. They chose today, of all days, to announce this. And there's a look at Microsoft in the regular session. Just pulled back a bit over 1%. However, going to the 5-minute chart after hours, did sell off a bit after we got that news from the FTC. Falling almost 1%. However, it looks like some have already gotten there and bought the dip. So once again, when the FTC or European regulators come after these big tech companies, you see that initial sell-off, then the market kind of shrugs it off like, no big deal. They're still going to print cash anyway. And I agree with the narrative of this headline. Wall Street sees no alternative to US stocks in 25. TINA is making a comeback. And that's the abbreviation for the expression, there is no alternative. And so US stocks are the exceptional asset class, and for good reason. And more importantly, when it comes to investing, you've always got choice. Where do you invest your next dollar? What's going to give you the best yield? And like many investors, I don't find the idea of lending to the government for the next 10 years appealing, just to lock in a 4% rate whilst being short inflation. Remember, when you invest in bonds, at the end of the term, you get your principal back plus the coupon, the interest rate, the yield. However, some stocks, they're kind of like inflation-protected equities, and others like land REITs, their income's actually indexed to inflation. So that's the 10,000-foot view, but just looking up what's on deck next, and could indeed throw a curveball to the market, Trump's tariffs, in which he looks like he's going to waste no time, potentially with an executive order, day one, compiled together a team of very market-friendly policymakers. And I'd say Trump's learned a lot from his first term, how the White House and Congress works from having experience, mistakes he may have made, likely challenges and attacks coming his way, and one of his key members on the new team, Scott Bessent, a fiscal hawk, really wants to dial down government spending, speaking about getting the price of oil lower, and wants to keep US economic growth above 3%, while getting the budget deficit to 3% of GDP from its current 6%. And so this is already having effects in financial markets, with Trump already proposing 25% tariffs on Mexico and Canada. And so top automakers in the US are very reliant on Mexico for auto parts and the like. Ford 15%, General Motors 32%. And even though Ford just fell a little bit yesterday on that news, 2.6%, the market certainly priced it in for General Motors. Pretty big fall there yesterday, 9%. Got a little bounce here today. However, the stock's still in a well-defined uptrend. It's actually been performing really well all year. After it got really cheap last year, still only has a market cap of 61 billion. So again, like I've been saying, these tariffs could cause some short-term pain in pockets of the market. However, this will just incentivize GM when they build their next plant. Guess where it's most likely to be? That's right, on American soil. But the fact is, these tariffs are going to be more challenging for the world than America. They're designed to incentivize domestic production and influence the behavior of America's top trading partners. And since regulation looks set to be cut along with lower taxes, a lot of momentum already in the economy and market, American exceptionalism could indeed accelerate to the upside, and US stocks have already been outperforming the rest of the world for 15 years now, and by a wide margin. So we're getting this headline in The Economist: should investors just give up on stocks outside America? No, but it's getting a lot harder to keep faith. But that could be a classic magazine cover indicator, and it certainly doesn't help when we also heard from Cramer today, who said don't lose faith in the big tech mega cap. Now, of course, no one's wrong 100% of the time, but I'd say this is a little bit more contrarian than not, especially when you see charts like this. S&P 500's returns relative to the rest of the world, now more than 3 standard deviations above the mean. We are certainly stretched here in the short medium term with the relative performance and valuations of US versus the rest of the world. However, keep in mind those indices are skewed by the top 10 stocks, and there's also good reason why American stocks have performed so much better, because their underlying fundamentals have performed so much better. Just looking at S&P 500 500 revenues currently at all-time highs, and the percentage of revenue companies are spending on their capital expenditures, 6.4%, buybacks of their own shares, 5.6%, and dividends, 4%. And so you can see the general trend in companies buying back their own shares and paying out dividends as a percentage of sales has actually increased this entire secular bull market since March 2009. There's strong tailwinds for this market. When you got revenues, EPS, buybacks, and participation in the market, remember, anyone with a mobile app around the world can buy US stocks. That is all really strong structural reasons for why US stocks have outperformed, and those things have to change for the relative results to change as well. But again, as investors, I want to remind you, you're not limited just to investing in one country, even if it is your home country. Just looking at my stock picks portfolio, current geographical exposure, and as my members know, it's been like this for a few months. I've actually had less than half of my portfolio listed in USA stocks using their company headquarters to determine the geographical location of the company. So like I said, we've been doing really well with Argentina, but I've got stocks coming out of China, Israel, Canada, along with a little bit of exposure to UK and Australia as well. So even if the US market does correct and the rest of the world does better, you can still profit from that, even with stocks listed in America, otherwise known as American Depository Receipts, ADRs. These are stocks that trade on these foreign exchanges, but they are also listed in America as depository receipts. They trade exactly like stocks. And so that's what I've got in my stock picks portfolio, a bunch of ADRs, and that gives us really great diversification. And that, along with dollar cost averaging, is what helps us to get these really smooth equity curves in our accounts, which makes it psychologically a lot easier to keep investing. Something I'll be doing in my swing alert service as well, keeping a very diversified portfolio, not having too much concentrated exposure to any one part of the market. Because in my opinion, the only two free lunches in investing are dollar cost averaging and diversification, and so I practice both extensively. But like I said, things could be about to accelerate on the upside. Posted on X today, Mark Andreessen, billionaire venture capitalist, runs one of the largest VC firms in the world, pretty much helped create the internet, posting the generational leadership change I've been waiting 30 years for is happening across America right now. And it's just crazy when you think about it. Who could have thought even just a few months ago, yet alone a year or two ago, that would be seen posts like this? Elon Musk tells government employees working from home they can still work from home, just not for the government. You've got arguably the world's #1 entrepreneur, a big driving force of the US government now. He could unlock a lot of efficiencies, and like the rest of the team, start running the government like a business instead of a drunken sailor with a no-limit credit card. Already hinting at auditing their internal revenue service. Again, big structural changes for how the states are going to be run, bringing a whole new level of accountability and efficiency. With Mark going on to say, the entire country feels like it's been powered back up. Do you feel it? Well, here in the stock market, we certainly feel it. Things have been lit up since the election, and the market already caught wind of it going into it. And so we just got the latest numbers on GDP. US economy still growing at a healthy 2.8% annual pace, pretty much double what Europe and other developed nations are doing. While inflation may have found a little bit of a flaw, PCE came in today, same as GDP, 2.8% year over year as expected. Market's not really trading off this data much of late, so it's pretty much a nothing burger, but it could turn into something in the coming months. As like I said, the pace of inflation may be bottoming out here in the mid-high twos. Just looking at the annualized rate of PCE over the last 3 months and from 6 months. Just looking at this chart, looks like it could be a bit of a bottoming formation. Then once we get the official announcements on tariffs, and if around that same time we got a little bit of an upside surprise on CPI, may grab the market's attention back onto this, and that could indeed cause a little bit of a correction in Q1 once the honeymoon period of the election's worn off in the market, like it inevitably will. But for the here and now, things are looking good. It should be a bumper holiday trading period for the retailers and the like. Even the threat of tariffs hasn't been enough to knock over the retail sector. We have just recently broken out this week, going out to a weekly chart, something I've been talking with you guys for a while now. This consolidation in retail seems to have resolved to the upside like we were thinking. So that's a pretty good sign for the US consumer. Market's forward looking, and I'd say they're pricing in a pretty good holiday trading period here. And I mean, just look at that rip in Walmart on the weekly chart. What a year it's had. If you adjust these returns for volatility and the tail risk in Walmart being very, very low, that is a crazy risk-adjusted return for the world's largest retailer by sale, $648 billion over the last 12 months. Simply incredible. Now just moving on to the other hot asset everyone's talking about of late, Bitcoin. Bouncing back again here today, just below $96,000 a coin. And so a few interesting thoughts for you today on Bitcoin. Let's just go out to a monthly chart on it, and let's just talk about it long term. So Satoshi wrote the Bitcoin paper in 2009. And as you guys know, that was literally the start of the secular bull market. And so Bitcoin's only ever existed in a secular bull market, with a big part of that bull market being excess liquidity. And so you could think of Bitcoin as a proxy for liquidity, because we may have not got this move had it been started in 2000 and the subsequent 15 years we had in the market, which was actually a lost decade for US stocks, because there's really strong correlation between Bitcoin, global liquidity, and NASDAQ stocks. We can see that in 2020, the COVID rip. And just like a lot of those tech stocks, high flyers, meme stocks and the like, they topped out exactly the same month Bitcoin did, November 21, and they bottomed exactly when Bitcoin Bitcoin did. Now we've got the NASDAQ, high-flying growth stocks, global liquidity, all bumping up. So is Bitcoin. So my point is, what happens to Bitcoin when we inevitably get the bear market in stocks, the real bear market, not just the pullback like we had in 2022? Because like I said, looking at the S&P 500, in my eyes, 2022 wasn't really a bear market in the classic sense, in my opinion. I know a lot of people say, oh, technically it came off 20% since highs, but that's just an arbitrary number. It doesn't adjust for volatility in that. And I mean, look at that chart. It just looks like a pullback in a secular bull market, right? And so Bitcoin was created here. And so is Bitcoin just a symptom of excess liquidity and enthusiasm from a secular bull market? Because in my opinion, and I know a lot of you guys watching this think differently, and that's fine. That's what makes a market, and we can't obviously agree on everything. But in my honest opinion, I don't think Bitcoin is going to keep compounding at 30% a year like it has done since 2009 into infinity like many of the crypto bros are saying. And again, that's not to take away from blockchain technology, digital payments, and lots of other good use cases for digital assets for sure. My argument is just with its valuation, the forecast that it's going to compound at 30% a year forever, and that MicroStrategy has found the infinite money glitch and Saylor is destined to become the world's first trillionaire. Because again, in my opinion, the guy's delusional. Posted on X today, MicroStrategy is a credit default swap on 100 plus trillion in 20th century assets. In other words, he's saying his company that's completely levered into Bitcoin is insurance on stocks and property blowing up. So in other words, he's saying the stock market and property could go to zero and MicroStrategy will be the only one left standing, and that'll be the payout to investors. With him also posting this graphic today, just another day at work. And so this is what he calls work, pumping up Bitcoin. Doesn't actually make a product or service, he just talks up Bitcoin. That's his work. But like this person posted on X today, when one buys MicroStrategy, for every dollar spent, you get 40 cents of Bitcoin and 60 cents of premium. Unless the premium is perfectly correlated and rises with Bitcoin, you are buying a deleveraged position in Bitcoin. Most of your bet isn't on Bitcoin, it's on the premium. Is that what you want? Couldn't have said it more perfectly myself. MicroStrategy is trading at $3 for every dollar of Bitcoin they hold. The asset's full of hot air, premium. That's based on sediment liquidity and his ability to pump up the stock to innocent small retail investors. With even the famous Jim Chanos, billionaire hedge fund manager, known for targeting fraudulent companies, he was the one that first sounded the alarm on Enron back in 2001. Commenting on his post today, I know where you can buy that same credit default swap at a 70% discount, implying if you really think global assets are going to blow up and Bitcoin's going to be the only one left standing, just buy Bitcoin itself. Don't pay 3-to-1 on Saylor's pump. And it certainly doesn't help when Cramer's getting more bullish on crypto as well, talking about adding some other cryptos into your portfolio. And so things are starting to get a bit frothy in the crypto space. Like this guy posted today, he's getting messages talking about meme coins, everybody's getting rich. We've got news a Chinese company, SOS, plans to purchase up to 15 million worth of Bitcoin, and the latest small company trying to replicate MicroStrategy's infinite money glitch formula. And like I said, it appears to be working for the here and now. This same little tiny Chinese company, SOS, up 42% today, just on news they plan on buying Bitcoin. And like I said, signs of froth, meme coins, small coins. Here's one for you guys. Fart coin, up more than 10x over the last month. Maybe this could be one of the currencies of the future. Go down to the shop to buy a pie. The cashier will tell you, that's 5 fart coins, good sir. Maybe not, right? But like I said, the pump is working for him as he systematically offloads shares in MicroStrategy. But there's plenty in the industry looking to cash in on it, including fund managers, coming out with a leveraged MicroStrategy ETF, MSTU. And just look at the volatility in this thing. Just over the last 5 trading sessions, down 50%. And this is just a pullback in the stock. My bet is in 2-3 years, this will have gone to zero. And like I said, if I was looking for exposure in crypto, in my opinion, Coinbase looks a lot better to me, as it still gives you exposure to Bitcoin, but also the trading around Bitcoin, the custodian Bitcoin. And I mean, the whole industry is kind of hilarious when you think about it. Like I said, the original purpose of Bitcoin was to be a decentralized form of anti-fiat currency used as a form of money. Now the majority of the industry has been custodianed by Wall Street with these ETFs and other managed funds. So in other words, cryptocurrency is no longer encrypted, not your keys, not your wallet. And it's diverged so far from its original intention. And thanks to the like of Saylor, is turning into something completely different. He's really trying to corner this market and he wants you to go all in on it and his shares. Whereas I'm just trying to warn you guys, be careful and please don't go all in on anything, no matter how certain it seems to you. But anyway, that's financial markets for you. I'm sure it's not the last of it. We'll be seeing about this interesting story. But like I said, guys, the stock market's closed for tomorrow. Just want to wish all my American friends a happy Thanksgiving. Hope you've been having a good year in the stock market. I'm excited about what's to come for next year. Of course, it'll be challenging as usual, but with that volatility can bring good opportunity. And keep in mind, Black Friday, half trading day, closes at 1 p.m. And like I said, if you're in the market for electronics or coffee, may not be a bad time to buy the dip. Because if this is what's happening in the futures market, the price at the shop is about to go up a lot as well. Otherwise, that's a wrap for the daily market review, guys. Thanks very much for tuning in. I'll be back again on Friday afternoon after market close to wrap up the week for you guys. And like I said, if you want to join me on my journey, turning my new swing trading account into $1 million, I'm going to share all the inevitable ups and downs we're bound to encounter, and I'll be doing my best to meet the outlined objectives. If you want to jump on board, now's your chance. Click the link below this video. Head on over to my website, clickcapital.io, and secure your spot before this is closed to new members. Thanks very much, guys. Enjoy your day off in the markets, and I'll see you again Friday afternoon. Cheers.